Good morning, everybody. It is Monday, February 24th, 2025. I am back from almost a week in Las Vegas. I will tell you, as I get older, full weeks in Las Vegas become harder and harder and harder on me because you just can't resist the urge to do stuff. I was at the Money Show for 3 days. I got to meet a lot of people. I met Eddie Ardeni. I met 10 or 15 people that I had been loosely following. Bumped into Michael Gayed, who I talked about. He has this post, which we'll talk about in a second. And I got to talk to the head of trading with Interactive Brokers, and he's a smart guy. You can read his material on the Interactive Brokers website whenever you want, Steve Sosnick. And he had very similar concerns to what I've been discussing for the last couple of months. So it was a good trip. I went to Bugsy's Steakhouse at the Flamingo one night. I don't do a lot of steak dinners because one, if I eat steak once a month, that's about normal. And usually I make it because steak's really not that hard to do if you buy a good cut of meat. And I don't like paying so much for the restaurant experience for steak. It's just steak. If I'm going to a restaurant, I want them to make something that I'm very unlikely to make or that I'm trying to learn how to make. They had a tomahawk ribeye that I bought, which again, I don't do much of, but I just wanted the presentation. I got a good table for 7 people and wanted to do some presentation. The chef was supposed to come out. He never came out. I don't think they had their high-end chef there that night. But the tomahawk came out, and I know how to cut it. You cut down the bone, and then you fillet it. I had the waiter do it, put on a little show. It was really good. Bugsy's has a really cool speakeasy kind of behind the dining room. I know that this isn't something that people in the whole country do, but Wisconsin, it's a thing. We put bars in our basement, and I think that is how I'm going to design my basement, if I am allowed to. I'm still waiting for executive confirmation of what our building and housing plans are down the road. The dessert they had there was a chocolate cake. I recommend that you get that if you're into chocolate. It's enough for 3 or 4 people, but it's pretty awesome. And the prices at Bugsy's are about 10 to 20% lower than other steakhouses in the area, and it's every bit as good. They all use the exact same distributors, and honestly, how do you screw up steak? So good meal. Other than that, overpaid for everything else. And I think I was probably out $3,000 a week in Vegas cost me. So, that's not so bad. It was mostly meals. I paid more for meals than anything else. Gambling, I think we probably spent $1,000. Normally we win at gambling because I play poker and I just didn't put much into it this time. Was doing the tier credits so that we get free rooms. We had 5 nights in Vegas for $400 for 2 rooms. So they treat me pretty well. That said, the Money Show, back to that, it is clear to me that people are underestimating the impact of AI on corporations and industry in our life. Blockchain is completely flying under the radar for probably 98% of the people. What's going on there is nothing short of revolutionary for the software as a service industry. And I think that once you get past the shit coins, then you can see what blockchain is going to impact. The example I keep giving you is California put all of their car titles on blockchain in the last several months, and they'll be rolling that out via an app to everybody. I think that almost all property and most transactions are going to be recorded on blockchain in the future. I don't know how long it takes for that to roll out, but I would think by the end of the decade, you are going to see massive momentum towards real estate, towards cars, towards jewelry, art, memberships, everything being handled on blockchain. And that is going to reduce the spend on software as a service. So the companies that adapt it could increase their margins, but companies that don't could be wiped out. So pretty monumental what's coming. On the AI side, it really is the industrial and commercial winners that are going to be the big money makers, I think, in the future. As I've discussed again several times, I bought a really good AI 5 years ago, and I thought it was really good. It cost me $20,000. Had a very difficult interface to use. Today, I use Perplexity AI for $200 a year, and it's basically ask it a question. They have a new deep research function on there. $200 down from 20,000. And it's a 99% decrease in expense, and it's probably 10 times better. So, it's just monumental what's coming. Think about all the corporations that can use AI for basically all their first tier service, and getting rid of a lot of middle management, which we talked about way back after the Consumer Electronics Show in 2020. So all these things we talked about in 2020, they're happening right now. And it's that 10-year window that we said would be the adoption. We're halfway through it. These next 5 years are going to be just huge, huge. And I stand by the idea that the new wave of drugs that are coming through pharma, the AR-related, AI-powered industrial and commercial uses for augmented reality. Think of a surgeon, think of somebody who's repairing something, think of construction, think of all the ways that augmented reality can help somebody be much more efficient, potentially help control a robot that's helping you, whether it's a little robot that goes in your body or a big robot that builds a building. This stuff is all coming. So it is our job to figure out which companies are going to make a lot of money on that, despite the upfront capital spend. So during this capital spending period, a lot of people say, they don't make any money. Well, it's because they just poured a whole bunch of money into upgrades, like building a refinery, right? Companies that are building a refinery don't make a lot of money, but once it's built, they make a lot of money. So if you can navigate those CapEx cycles, buy when the traders and the know-nothings sell things off, you're going to do very, very well. So I'm writing the options expiration update for February. I have the options selling outlook, and I think it's important that you take a look at this. So I continue to be cautious on the broad market, the S&P 500 in particular, things that are correlated to the S&P 500. Large caps are highly correlated to liquidity, which is M2 money supply, and its availability and its momentum and its velocity of that money. So large caps are very susceptible to liquidity pressure or liquidity shocks. There are a few things that I think will put a lot of pressure on liquidity this year and into early next year. So the Federal Reserve is continuing with quantitative tightening. We've known that 2.5 years now. That is the opposite of money printing. So everybody says, the Fed prints money. Well, no, they've been unprinting money for 2.5 years. They've been taking money out of the system. So this idea that the Fed is pumping the economy, no, they pumped it a ton during COVID, and now they've had the brakes on, not like jamming the brakes, but kind of like making sure that you don't accelerate down the hill, right? And I think that's a good analogy, actually. All that money that we printed, which was way more than we needed, we're slowly whittling away at it, and we're getting close to the point where we're at the bottom of the hill, and there's not going to be that accelerating factor from coming downhill, spending all that money. So they printed all that money to get us to the top of the hill, and then we've just been accelerating down the hill because we're using that money up. Well, they're unprinting, and I think that at some point it's a big deal, especially given the potential for very real crowding out as the government refinances almost $7 trillion of debt this year and next year. Government budget cuts and potential government shutdown in March, those are things that could be a shock to liquidity. And then another unwind of the yen carry trade appears imminent. This guy points that out. So his little meme post, and this is a guy I actually know. I talked to him at the Money Show. Known him 15 years now, almost 15 years, back to 2012, I suppose, when I got on Market Watch. But representative of the yen carry trade unwinding again. What is that? The yen carry trade is when people borrow money in another currency at super low interest rates to invest it somewhere else at higher rates of return. So with the yen being able to be borrowed at zero for a very long time, people were borrowing yen to buy dollars and invest in dollar assets and other assets. But they're borrowing the yen. They're taking loans out in the yen, which also had a pretty good conversion ratio, and they were getting magnification on their money, the amplification, the increase in value of money and borrowing at zero. So now you can't borrow at zero, and the dollar is really strong. So the yen carry trade, given that Japan just had a big inflation number, which makes sense, right? Because they don't have a lot of their own stuff at the materials side. So Japan has avoided inflation for decades, but really that was on the back of their manufacturing, and that materials and energy were cheap. So what happens if we have a period where energy and materials are expensive, even if only for a few years, which is what I think. I don't think these things will be expensive in the 2030s. I just think they're going to be expensive during this transition period. And if that money can't be used to buy other assets, then liquidity to buy assets goes down, right? It's just pretty ABC. There's not a curvy line here. Borrow money cheap, invest it somewhere else, and push those asset prices up. Well, if you can't borrow the money cheap, then you don't have extra money to buy those assets and push the prices up. On top of that, 13F filings have been pouring in, and they're 3 months backwards looking, right? It's what happened in the last quarter, but big buyers are starting to show very big selling. And we know that corporate executives have been selling at record paces. So you have the most in the know people and executives trimming, and you have the biggest investors, presumably smart, trimming. Berkshire Hathaway, biggest cash pile in history. And a big hunk of that is really good operating margins from the insurance businesses, but they've also been net sellers for the last 3 quarters. So the idea that smart people are all buying is not true. This is going to be hard for you to look at, but you'll see that Berkshire has been cutting their Apple is down a lot. They didn't sell any last quarter, it doesn't look like, but they reduced their Bank of America by 14%. I don't think anybody should own big bank stocks. If you own JP Morgan or Bank of America or US Bank or any of those big banks, sell them. Just flat out sell them, because they are at the top of where they can be. They are priced for perfection, and I don't think the odds of perfection are very high. He did buy a little bit more Occidental, as some VeriSign, loading up on Sirius XM Holdings, as am I. That's a company that just has very little downside, pays a dividend, and they could show a big improvement on growth and potential M&A. So they were net sellers again, which is, I think, telling. When you have that type of a war chest, and right now their cash exceeds their public equity holdings, not their private equity holdings. Their private equity holdings, right? They own whatever it is, 120 companies. Still the biggest part of their portfolio. Kind of think of it as half in private equity, a quarter in public equity, and then a quarter in cash and short-term investments. And actually, it's about 30-ish% cash and short-term investments. So it's kind of like 50, 20, 30. I think that's important. It doesn't mean that you have to sell everything, but it means at least that it's hard to buy things because of the prices, because of the uncertainty in the economy, because of the pressures on liquidity. Again, liquidity is 99% correlated to asset price returns. If there's a shock or a drag on liquidity, and there are several that are apparent, that's just not good. So while the traders can buy the dip, they can BTFTD, right? They have an acronym for that, buy the blank and dip. And they can do it for a while, and they're using margin, which is drifting higher, and they're using options, which are through the roof, to buy. And that's why we can sell options at really high premiums, because these idiots are trying to get rich quick. Stocks go up, and they think, if stocks only go up, I can get rich quick because I'm smart. And until, of course, stocks go down and bad things happen that are somebody else's fault, right? If you get rich, it's you. But if you lose a lot of money, it's somebody else. Just remember that. Remember that. That's important. It's important for self rationalization and finding your place in the universe. So I am going through the cash secured put charts. I'm going to try to keep these chronological. I'm not doing a good job, but I erased all the January stuff. I'll fill in the newer stuff. Where I am selling cash secured puts right now, I am selling cash secured puts on Enovix. Oh, this one's juicy, juicy, juicy. So I'm selling the April puts. I was selling $10 puts, and I'm going to stick with selling $10 puts. I want this one put to me. And this is a stock that I talked about in the chat room last week. I asked a question. Nobody gave the right answer. I had said that there's an emerging reason why Enovix is going to make a lot more money in the future. And AST Space Mobile has something to do with it. And people gave me a bunch of answers that were wrong. Here's the thing. AST Space Mobile is doing what for emerging markets? They are bringing 4G and 5G connectivity to 2 billion people in the next several years. Enovix has contracts with 7 out of 8 of the biggest cell phone providers, smartphone providers, builders in the world now. They just announced that. So, in 5G, right? A lot of cell phones, and Enovix is putting batteries into a whole bunch of those. As that connectivity comes online the next 3 years, and Enovix continues to ramp up their production, they're going to make a lot of money. And then there's the idea about, well, but what about tariffs on them? What do they care? If they're building in Malaysia and selling to Southeast Asia and India and Africa, what do tariffs matter to them? Here's the thing. They can still sell into the United States and avoid the tariffs. How do they do that? Pretty easy. Contract with an American battery maker and just collect a royalty on them using your technology. Stuff like that happens all the time. So I think Enovix, a TJ Rogers company, has done very well to get to where they are. They have their first lineup, their first manufacturing line up in Malaysia. The second one is coming imminently. So I think that this sell-off on Enovix, which I don't really know what the narrative is that's causing it, doesn't matter. You use trader narratives to get good prices. So whether you're a buyer or seller, right? If the traders have talked something up and they've spiked it and they made that chart look straight up, sell into them. And if they have pushed something down in that kind of wavy way down, buy it, especially on that second dip. So I am making Enovix a full position. I was buying the stock on Friday. I'm going to buy some more today, and I'm going to continue to sell cash secured puts. I think that this is a potential 500% to 1,000% move, 5 to 10x by the end of the decade, and I like those types of gains. So I'm just going to keep selling the puts here and let some of it get assigned to me, end up with a full position, maybe a double position. We'll see. I like to see things going up before I make them a double position. Not something that I've always followed religiously. I should, but I'm really liking Enovix right here. The other TJ Rogers company is Complete Solar. They just keep executing. And it looks to me like they are done with any dilution. They're projecting being potentially profitable by the end of this year. If not this year, then probably next year or the year after it. It doesn't matter. They're not really losing money anymore. They've built that company from the ground up, super cheap. They bought SunPower out of bankruptcy for $45 million. Remember, it was a $9 billion company at one point. So even if it only becomes worth $1 billion down the road, there's still, that's 500. That's actually almost a 10 bagger on that stock. So I think Complete Solar, for you adventurous long-term investors who like to buy something that might be super valuable for super cheap, with the idea that there's not much downside if it doesn't work out, I think Complete Solar is one of those asymmetric, low-risk investments. I really do. I just don't think there's much downside. And even if they muddle along, they'll stay worth what they're worth. And if they execute and solar becomes even more of a big deal down the road, again, I will stick with the idea that 20% growth rates are good. They have that. I think that climate change is real. I don't care if you believe it. And if there's a shock to the system from hurricanes or whatever, if something moves the collective consciousness on climate change to be more urgent, which I think is inevitable, then stocks like this are going to go up and up and up and up, because it's the only way to stall the damage to the planet, and hopefully 100 years later it's better. So, I think that these clean energy stocks they're plumbing the bottoms. They really don't have much downside given their growth rates, and the survivors have pretty good balance sheets at this point. The ones that are gone, but the ones that are surviving, in complete solar, you can't really sell puts on complete solar. It doesn't have a market. The ones that have survived have bought assets out of bankruptcy, have picked up market share because a competitor disappeared. I think they're going to do very well. I don't know how fast, but I do think this pause in the bull market this year, if it indeed turns out to be a pause going into next year, once they get through this liquidity pressure, the yen probably is just a shock. I think at some point the government shut down its bias. At some point, they've got all the debt refinanced out for 5 and 10 years. We're going to, then there's deregulation, and then they're going to do tax cuts we can't afford for the wealthy. And they're going to do a bunch of things that probably lead to a speculative furor into the second half of the Trump presidency. I really think that we're going to get a blow off top. I don't think we've had it yet. We're overvalued, but we haven't had a blow off top yet. So last year, when I said expect euphoria, we've got euphoria, and now we're taking a pause. People are starting to go home while other people are like getting ready for what? The after party. The after party to this bull market is coming. I think it's next year. I think it starts next year sometime, and then it runs for a couple of years. I think you very well could see next year be an up year, and then 27 and 28 be like the last 2 years, a couple of years that are 20, 30% up years. That gets us to 8 to 10,000 on SPY, and then that's it. And then I think speculation has run amok. I think that things start to break in private credit because I don't think wages are going to keep up. I think that inflation, because of the decreased globalization and the pressure on immigration, I think they just start breaking things. And if you've been paying attention, they don't really care if they break things. And I don't think that they understand some of the things that they break. So honestly, if I had to place probabilities, and here's where I compare to Ed Yardeni. Ed Yardeni said that his odds of a melt up are 55%, of a spike and crash are about 25%, and stagflation 20%. I would flip that over. I think the odds of a melt up are about 20%. I think the odds of stagflation are about 25%. And I think the odds of a spike and crash are about 55% over the next several years. I could be wrong, but those are the three scenarios that are out there that we can look at and say, I think these are the three scenarios. Now, there's probably a fourth or fifth scenario that we're just like not wrapping our head around. That's the nature of black swans. But I think that the way things are lining up from my viewpoint with the deregulation and coming tax cuts, and they're going to they might get rid of the debt ceiling. I think we're going to probably increase the federal debt quite a bit the next few years. And then people will say, yeah, but it's going to pay for itself down the road. And then it won't, because it didn't last time or the time before or the time before. Last 3 times we've tried this, did not work. Why would it be different this time? So that's what that's what I think is going to happen. I can handle whatever comes because I'm just mechanically selling options and collecting premium. But if I'm right, then the secular trends from AI and from blockchain are going to get supercharged, at least in the short term. You're going to have a lot of speculative fear. as they pump money into the economy. So at the end of Trump's term, if everything is up, he can say, look, I made it all great. And then when it crashes, he'll blame the next guy. See, they changed it and it broke. We're getting set up the same way we got set up the first term. People want to blame COVID for the crash in 2020, and that's valid, but I had predicted it was on its way anyway. So, I guess we'll never know, much like we don't know how many licks to the center of a Tootsie Pop. Although I found out on this Vegas trip that somebody built a robot, see how many licks it did take to get to the center of Tootsie Pop. And it was like 139 or something. I don't remember what it was. It was some number. So I would just be cognizant of the fact that in the short term, this year and into next year, that liquidity is very challenged. And historically, like every time, not most of the times, every time, that has led to either a choppy market or a down market. Which one will it be? We'll see. And I mean, it could just be a choppy market because all the money that was printed 3 years ago. We'll see. There are some wild cards out there. This bird flu thing is, I think, going to be a little bit worse than people think. And it's going to be worse not because it kills a lot of us, but because it's going to kill a lot of chickens and some cows. The analysis out there, if you take a look at Nature magazine or some of the other magazines, is that we are at risk of losing half of our chickens and a third of our cattle. So that's a big deal. If you've noticed, milk prices and cheese prices are 25-30% higher than they were a year ago. That is partially reflected from bird flu. I don't know what the other factors are, but for whatever reason, beef is still expensive and dairy is still expensive. Pork was cheap at the store last couple. I went yesterday for a minute, and they were practically giving away pork tenderloin. So apparently the pigs are happy. Then you have the fact that eggs you want organic eggs, you're paying like $8 a dozen. So I've switched from organic to just, the ones that are at least cage free and antibiotic free. I try to get antibiotic free. In fact, I don't think I've had antibiotics in most of my food in a long time. So if we get a shock to the food chain, that's significant for inflation. And especially if we have a liquidity problem that slows the economy, that is your recipe for stagflation. Breaking global supply chains is bad for inflation, because you can break a supply chain today, and it might take 5 years to fix it domestically, right? So there's this big time lag. So people can say, oh, Apple committed to $500 billion in new investment in the United States. Not really. They committed to $430 billion 4 years ago. They added $70 billion over the weekend so that Trump would get off their ass and give him a headline. They may not actually spend it. And a lot of these companies are doing the same thing. So a couple of the foreign investors that came in, they get sweetheart deals on taxes and reciprocity and other things. Trump gets a headline, and I'm not saying the investment's bad. You want the investment. However, just understand there's a time lag between the time that we break a global supply chain, which is like kind of doing it now, to by the time all this stuff gets built out, which could be 4, 5, 6 years. So I'm not saying that it doesn't work out in the long run. I'm just saying that it's a transition, and transitions are painful. The other thing that hit the news over the weekend was a new coronavirus impact, or a new coronavirus that they found at the Wuhan Coronavirus Clinic. This one profiles as Disease X. Disease X is something that spreads easily and kills a lot of people. COVID, while it spread easily, relatively speaking, did not kill a lot of people, right? You had to have a comorbidity, generally be old or overweight. That's mainly who it killed. And it wasn't everyone. I mean, my grandmother at 90 years old or whatever she was at the time had it, and she was like, you can't hurt me with this, So it was actually the COPD that got her down the road. If this ends up being another pandemic, which I don't think that it will be, but if it does, I think that you can expect things to be much worse, because there's so many people who will just go, it's just like the last one. and it won't be. So the impact could be much, much worse. Again, I don't think it's going to escape. I don't think it's going to get out of control. Honestly, I'm not a wipe out a species sort of guy, but I could see bug bombing all the caves in China and getting rid of a huge percentage of the bats. I know that messes with the ecosystem. That's bad. I don't know. They have to figure out a way to contain it. I think they will. Maybe it's through extermination. Maybe it's something smarter. But there are risks out there that I don't think we assign much risk premium to. And I don't think it'll take much. And I do think the bird flu is a bigger deal. I don't think it'll take much, right? So we'll see. Somebody asked about impact on Ametis from the bird flu. Yeah, if some of the cows die, maybe there's a little bit less dairy, cow farts to turn into gas. I don't think we're to the point where we're converting so much of it that we would notice. There's going to be enough cow shit, so we'll see. I mean, if all of a sudden we have to cull 90% of the cattle herd in America, we got bigger problems, right? Now we have food problems, so we'll see. But I don't think that there's an impact. I think it's negligible impact on any of our companies. Speaking of Ametis, they reopened their biofuels plant today. They got permission over the weekend, so they're ramping that up right now. They still have inventory. They're fulfilling their contracts. They talked about their IPO in today's press release. I increased my personal holdings in Ametis on Thursday and Friday. It is once again my largest position as I trimmed a lot of other things. Not really trimmed a lot of things, but I trimmed my AST Space Mobile a little bit, sold some covered calls. Again, not because I don't think it's going to the moon. I do. I think AST Space Mobile's for sure getting to $100 a share, but I think there's going to be rockiness. And I think in the short term, because of how they're financing things, I don't think it breaks out soon. I think it breaks out next year. So I can collect some premium on Ametis, some premium on AST Space Mobile by selling covered calls. We can take a look at what a covered call would look like on AST Space Mobile. I don't know if the stock's up or down today. It's down $1.26. So the day to sell, like May covered calls probably would have been last week. I think you're probably just a little bit late. But if you've been selling $40 covered calls last week, you would have got like $5. You get $2.56 to sell the May 45s right now. Yeah, I don't think that's horrible. If you have a gigantic position in AST Space Mobile like I did, I think that you could do that. So again, it depends on how big your position is. I showed my personal portfolio the other day. I don't own many things. I just own a lot of a few. So I'm hyper aggressive, as far as being focused. I'm just not a diversified guy when it comes to investing. I have to diversify for clients because I'm regulated, but I have a lot of clients who maintain a trading account so they can focus on 6, 7, 12 companies and they can have the overweighting that they're comfortable with. Because again, I'm regulated. I have to be able to say to a regulator, this is why I did this. And this is close enough to the prudent man rules and ideas and the backwards ideas about investing that regulators have to satisfy them. So you can be more aggressive based on you, and far more aggressive than I can be for you. And that's why I do the investment letters, because there are plenty of people out there who, hey, Kirk, can you manage the option selling for me? Maybe the ETF asset allocation, but I'm going to keep 100 or 200 or 500,000 or $1 million over here, and I'm just going to focus on the top ideas. And that's great. That works out pretty well, actually. I like that arrangement. So I don't mind when my clients piggyback my top ideas. It doesn't matter to me, and it allows us to have a relationship that really, I think, helps better fit everybody's risk parameters, right? And it offloads work for them, right? They don't like doing the other stuff. They just want to have their 10 stocks or 12 stocks that they really focus on. All right. So if you get a pop-up in AST Space Mobile to over 30 is where I'd look to sell these May $45 calls. I don't know when it's going to happen. Maybe this week, maybe not. But, this was what, 32 the other day. So you got better premiums. That's on you. You have to decide, okay, what would I take in premium and what strike price would I like? I'm telling you that the strike price I think you should like is May 45. And as the stock gets into the 30s, I think you can sell it for a really big premium. And I think that this stock is probably choppy for a little while because of the macro, but also they're in their capex period, right? It's just going to be hard for them to break out without a whole bunch of new revenue, which they're not going to have till next year. All right, any questions? I own the SPY March puts, right? I have not rolled anything out or bought new puts. I own SPY $550 March puts, and if we don't get a correction in the next month, I'll just buy new puts after that. You don't want to pay for time value, right? You never buy long-term calls or puts. And to be very clear, the only reason that I buy some puts are to hedge my long positions. I'm not speculating on the market going down. Most people should avoid ever shorting the market or buying puts. And I think that for most of you, that's probably true. If you just focus on those fundamental trends of secular changes, I talked about AI and blockchain today. If you focus on the secular changes and you use the trader narratives, right? Like the Karate Kid uses the other, martial artists' weight against them, right? Just use the leverage that the market gives you. And the traders whipping things around because they're all super smart and they're all going to get rich quick and they all know what they're doing, right? I am being very facetious there. You can use those traders' narratives, which are 90% bullshit. All right, they're just rationalizing the move of the day. Oh, this must have happened because of that. It went up because of this. It went down because of that. Bullshit, right? They're just running their lips because that's what they do, and they have to justify things. So use the movements in the market to get what you want to own for the long term cheap, right? You should know what your top 20 ideas are, and you should know about where, based on those volume bars that I show you all the time, you should know about where you want to really accumulate. And when the traders give you those opportunities because they're flapping their gums about whatever, and they push a price, there you go. And sometimes they flap their gums, they push something up, and you're like, I ain't worth that much, but I do want to own it long term because it will be worth that much. So I'll sell a covered call to get through the time period. If it gets called away or it's about to get called away, then I'll roll the covered call. Rolling a covered call is easy to do and usually works out. Ideas on oil and gas energy stocks. Same two ideas that I've had for a very long time. Permian Resources, because they're in the Delaware, which is gas rich, and Coterra, no N. Shooters got me putting an N in that word, and there is no N. Coterra, Coterra, because they have gas in the Marcellus. They have some assets in Oklahoma they should sell. And then they have the Permian Basin, again, Delaware Basin, gas rich. I think the gas rich oil companies are the ones that you want. And the Delaware Basin of the Permian, which is where Coterra and Permian are great plays. They both have potential M&A in their future. I think there's one more M&A wave coming to that space. They might even let Exxon and Chevron buy some of these companies, although I think there's more likely to just be mergers. And then you get the merger synergies and more contiguous land, masses, easier to drill, longer laterals. So Permian Resources and Coterra, I'll stick with those two. I don't think there's really a lot of other things to do. Occidental is a super long-term play, but you can own that through Berkshire Hathaway. There's not really a lot of premium in selling the puts anymore. The stock is cheap, though. So I don't think there's much downside on Occidental. And the part of the company that nobody values is the carbon capture and the carbon transportation. That's a big deal. It's just a really big deal. So while the pipeline companies are all fully valued, companies that are primarily oil pipelines, you should be selling them right now. companies that are primarily gas pipelines, you can hold them, but you probably don't have any upside left, right? Or very little upside left. So Kinder Morgan, I told you to buy in the teens. I said it'll double, get close to 30. That's where it is now. I don't own Kinder Morgan anymore. I don't own EPD anymore. I don't own Enterprise Transfer anymore. I don't own any pipeline companies anymore. They're either fully valued or overvalued, and the oil pipelines have a lot of risk. This idea that people have that peak oil isn't going to hit till 2040 or 2050 is off the charts wrong. Just off the charts wrong. Peak oil demand probably hits around 2030. The 2030s are probably marked by a plateau, sideways movement, as the fleet of cars, which is the oldest in history, is replaced by vehicles that have much higher miles per gallon and miles per gallon equivalent. The EVs that are coming, that have the onboard generator that'll be, a couple gallons of gasoline or diesel, just the mileage that you're going to get from an EREV, extended range EV, for 2 gallons of gas to get 500 miles of range, or 3 gallons of gas to get 500 miles of range, you're going to start to see equivalent MPG of way over 100 miles. That's tripling the miles that you get per gallon from what we get today. I mean, close to 60% of all oil goes to transportation, and about half is cars and trucks. So if we cut that need by 2/3 over a decade, what does that do, right? And then if you have the oil producers realizing that's coming, they're going to try to get their oil out of the ground over the next 5 to 10 years so that they can get something for it. So I'm just not super bullish on oil long term. I think there's a trade into the next few years. I think you probably can buy the dip and then sell the rip. But oil stocks just aren't long term anymore. They just aren't, because the technology is changing so fast that mileage is going to go up. Chemicals and plastics are using less oil. And everything that uses oil is becoming way more efficient. So I wouldn't think about ONG stocks too much, except in the context that gas, which I think the ramp on demand is much longer, is in a pretty good spot. Gas is cheap right now. And as oil production stays flattish, 60% of, I think it might actually be 70% of all natural gas is affiliated with oil production. So we're going to have to figure out ways to get gas. I think you can get some of it out of the Marcellus and West Virginia and things like that. But really, your gassy oil fields, which used to be less desirable, are going to become more desirable because people want the gas, right? So I think that's out there. Somebody asked about copper and FCX. I haven't looked at the price of FCX lately. Is it down in the 20s yet? Should have used, long way to go on FCX. Gets in the 20s, wake me up. This is just volatility, right? This is a correction. Wake me up when it gets in the 20s, and then we'll figure out if it's going down into the teens. All right. I think that was a good call. Let's leave it there. I will finish up the options expiration update as soon as we get off the call. I might make something to eat. I haven't eaten yet. I really like selling Enovix $10 puts, like right now today. I think that is a good idea for you. Well, since it's up, you probably sell $10 New Fortress puts for May. You get $1.17. I mean, that's over 10% for 3 months. That, 40% annualized, that's pretty good. New Fortress Energy is in really good position. So the traders hate it right now. Use their hate against them, just like the Karate Kid uses the weight against his opponent, right? Use the weight against them. I like selling those May $10 puts on New Fortress and the April $10 puts on Enovix. So it jumped up a little bit. So yeah, get a buck on that one too for, that's a 60% annualized return, right? 10% for 2 months. That's 60% annualized. That's pretty good. All right. Have a good one.